Welcome to the Daily Globe. Please subscribe and hit the bell icon for more breaking updates. Imagine the global financial system as a vast symphony, where every nation plays its part, and every currency has a role in the grand performance of global trade and investment. For decades, the US dollar has long served as its conductor, setting the tempo and tone for markets everywhere, orchestrating the flow of capital and trust across borders. But now, a powerful new note is emerging from the East. $10 trillion, the staggering sum Chinese banks have poured into their own government's bonds, signaling a dramatic shift in financial priorities. This is more than a domestic move. It's a strategic play with global consequences, raising a critical question. Are we witnessing a fundamental shift in the world economic order, or just a temporary adjustment in response to global pressures? $10 trillion dwarfs most national economies and signals Beijing's monumental bet on its own future, a wager that could redefine the balance of power in international finance. As the world reels from recent universal tariffs that wiped out global wealth, China's internal pivot takes on new significance, potentially reshaping how nations respond to economic shocks. This could either stabilize China's slowing economy, providing a much-needed cushion for growth, or concentrate risk to a breaking point, with inevitable spillover worldwide, threatening to trigger a chain reaction across interconnected markets. We'll explore the pressures driving this unprecedented bond-buying spree, the risks that come with such a massive financial commitment, and what it means for the future of global trade, the stability of international markets, and the US dollar's supremacy as the world's reserve currency. Is this a defensive measure to shield China from external shocks, or a bold move in a long-term game of economic chess, designed to challenge the established order and assert new influence? The stakes could not be higher, and the world is watching to see how this $10 trillion question will be answered, because the outcome could shape the future of the global economy for generations to come. To grasp this dramatic financial shift, we need to look inside China's economy, which is now facing some of its most turbulent waters in decades. The landscape is changing rapidly, and the choices being made today could shape the country's future for years to come. The once booming property sector is in crisis, with construction halted and homes left unsold. Consumer confidence is weak, and people are spending less, leaving banks searching for safe investments as the private sector slows down. With few profitable private sector opportunities, banks are turning to government bonds. Beijing is actively encouraging this shift, and with a lack of better alternatives, banks are following suit, pouring more money into state debt. This creates a closed financial loop. Banks fund the state, and the government uses that money for stimulus and infrastructure projects, hoping to jumpstart growth and keep the economy moving. For Beijing, it's a way to keep growth afloat and project stability to the world, even as financial stress quietly mounts behind the scenes. But critics warn this marks a retreat from market reforms, with capital increasingly flowing to state projects instead of innovative private firms that once powered China's rise. The risk? Crowding out entrepreneurs and starving small businesses of credit, making it even harder for them to survive or grow in this challenging environment. China is choosing to feed itself first, prioritizing internal stability over external dynamism, a move that could sap the energy and innovation from its own economy over time. The dragon's inward turn may bring stability now, but the long-term cost could be a less dynamic, less competitive economy in the future. This is state-directed crisis management, effective in the short term, but potentially stifling for innovation and private enterprise if it continues. The world is watching closely to see if this bold gamble by China's leaders will ultimately pay off, or if it will come at a greater cost than anyone expects. The numbers are staggering. As of August 2025, Chinese banks hold 72 trillion yuan, about $10 trillion in government bonds. This surge, with holdings up over 20% year-on-year, marks the fastest accumulation since 2019. It comes just as China's bond market bull run peaks and yields begin to rise, threatening banks with mark-to-market losses. The scale rivals the GDP of Japan or Germany, underscoring the immense size of China's banking system. Never before has a major economy concentrated so much sovereign debt on its banks' balance sheets. This is a direct response to weak private loan demand. Banks have become the government's primary financiers. Government bonds now dominate the assets of China's largest banks, creating a powerful but risky feedback loop. If bond values falter, the consequences could be severe. The world is watching this unprecedented experiment in state-bank interdependence. Financial experts are sounding alarms over China's ambitious $10 trillion bond strategy, a move that is sending ripples through global markets and raising eyebrows among seasoned analysts. One analyst calls it a slow-motion gamble. Banks are being ordered to hold government debt, effectively tying their fate to the unpredictable values of these bonds and making them more vulnerable to market swings. As yields rise, banks face mounting risks of losses, threatening not just their profitability, but also their ability to withstand future economic shocks or downturns. The danger isn't just financial. By funneling vast amounts of capital into state-led projects, China is starving its private sector of the resources and investment needed for true innovation, entrepreneurship, and long-term growth. Economists warn this could lead to stagnation, not sustainable progress, as the private sector's dynamism is stifled and economic momentum slows. The sustainability of this model is now in question. Can top-down directives and government mandates truly manage such massive systemic risk over the long term? A sudden crisis of confidence or a sharp downturn in the bond market could trigger swift, severe contagion, spreading instability throughout the financial system. The system's sheer scale projects power and confidence, but its concentration of risk makes it unexpectedly brittle and susceptible to shocks. China's financial fortress, while imposing from the outside, may be more fragile than it appears to the world. The world's second-largest economy is walking a tightrope, balancing growth, risk, and stability with every step it takes. The stakes are global, the margin for error is razor-thin, and the outcome will be felt far beyond China's borders. China's bond-buying spree has created a dangerous codependency between government and banks. If the government's fiscal health falters, banks holding its debt could face immediate, severe losses, a potential doom loop. With so much capital tied up in low-yield bonds, banks have less to lend to businesses, starving the private sector and slowing growth. Small and medium enterprises are already feeling the squeeze. The system is also highly vulnerable to interest rate shocks. If rates rise, bond values fall, and banks could see their capital wiped out. Everything hinges on confidence in the government's ability to honor its debts. But confidence is fragile. One misstep or crisis could unravel the entire system. The $10 trillion bet could quickly become a global shockwave. China's financial stability is now a high-wire act. China's $10 trillion bond bet is reshaping global finance. By redirecting capital inward, Beijing may reduce its purchases of U.S. treasuries, potentially pushing up U.S. interest rates. This shift could disrupt global supply chains and make China a less attractive partner for international business. The crowding out of the private sector means fewer opportunities for foreign firms and a less dynamic Chinese market. As geopolitical tensions rise, multinational companies are already diversifying away from China. A crisis in China's financial system would ripple worldwide, depressing demand and threatening global banks with exposure. The psychological impact is real. Investors are on edge, and market volatility is rising. China's gamble adds a new layer of uncertainty to an already fragile global outlook. The world's economies are more interconnected and more vulnerable than ever. What happens in Shanghai could quickly reach Wall Street. The stakes are truly global. For decades, the US dollar has been the world's reserve currency, giving Washington immense power. China's bond strategy is a clear move to reduce dependence on the dollar and build a foundation for the yuan's international role. The $10 trillion internal market creates a vast pool of yuan assets, laying groundwork for the future. Recent US tariffs and sanctions have only accelerated China's push for financial self-reliance. While the dollar's dominance isn't ending soon, China is building a parallel system. We're moving toward a multipolar currency world, with the yuan slowly chipping away at the dollar's empire. The global balance of financial power is shifting, one bond at a time. China's bond bet is a strategic move in a global chess game shaped by trade and tech wars. US tariffs have forced Beijing to fortify its economy, making the $10 trillion bond market a financial fortress. By relying on domestic capital, China can fund stimulus and key industries without foreign dependence. This is self-reliance for a more fragmented, confrontational world. The move also gives China leverage. Less need to buy US debt subtly weakens America's financial advantage. China isn't dumping US bonds, but a gradual reduction shifts the balance. The world is splitting, a US-led bloc and a China-led parallel system. The bond market is a cornerstone of China's new financial architecture. Beijing is playing the long game, declaring financial independence. The outcome will shape the global order for decades. China's $10 trillion bond bet is a new theme in the global economic symphony, forcing every player to react. It's a strategy born of domestic weakness but executed with strategic ambition, building a financial bulwark against storms and challenging the old order. The risks are immense: stifled innovation, systemic fragility, and a retreat from global integration. The tremors are already felt in markets and boardrooms worldwide. The coming months will be critical. Can China's bond market hold, and will the private sector survive in the state's shadow? The world is watching how the US and others respond to this evolving challenge. This is more than finance. It's about the future of our interconnected world. The $10 trillion question remains unanswered, and the world holds its breath. Stay tuned as this defining economic story unfolds.